Good afternoon. Today we're going to give an overview of asset classes and portfolio allocation process. What is an asset class? An asset class is a group of similar securities that function in a relatively similar way and are subject to similar laws and regulations. A financial security is a negotiable financial instrument that holds monetary value, for instance, the ownership of stocks, government or corporate bonds, or options. The three principal asset classes are equity, often referred to as stocks, fixed income as bonds and cash equivalents. However, some professionals also include real estate, commodities, private equity, art and hedge funds in alternative asset classes. Asset classes react differently to news in the market. For instance, stocks are very volatile to investors' perception of the company's performance and could produce very high returns or losses. On the other hand, bonds and annuities are much less volatile as they respond to fluctuations in market interest rates that occur less often. To further understand the asset classes, we will begin by looking at cash equivalents. These are used for short-term fixed income investments up to 12 months and are traded over the counter, meaning directly between two individuals. They are considered a low-risk, low-return liquid investment. Amongst the most common ones, we can find government treasury bills. These are securities issued by the government. Essentially, it is an individual lending money to the government in exchange for the difference in price between the purchase price and the redemption value. Another type of cash equivalent is commercial papers. These are used by corporations to receive immediate liquidity to satisfy short-term demands for money, for example, payroll obligations. Marketable securities are financial assets and instruments that can be easily converted into cash. The rates at which they are traded have minimal effect on their price, making them very liquid. The second asset class is fixed income securities. These are also known as bonds. They are traded on either the primary or secondary capital market. If government departments or companies wish to raise money, they may issue bonds directly to investors instead of obtaining loans from a bank. The investors become creditors who will receive interest on a specified basis. When considering the operations, investors need to assess its riskiness, the relationship between price and yield, the duration, and the effect caused by interest rates. Bonds are riskier than money market instruments as they are less liquid and affected by more factors. The last asset class we're going to explore is equity. This is also known as stocks. These are traded on the capital market. They represent a share of ownership of a publicly held company, otherwise they are referred to as private equity. And the main types of stocks are common, ordinary stocks, which would grant voting rights in the company, and preferred stocks, which have no weight in the company but priority over ordinary stock owners. There are no entry barriers as the minimum cost of investment is low. Investors look into two sources of revenues when buying stocks: a higher selling price after a certain period of time and dividends. These are uncertain since stock value is determined by supply and demand, and dividends depend on the company's performance. They are risky to some extent since they depend completely on the company's performance and its popularity on the market. A mutual fund is an investment vehicle made up of a pool of funds collected from many investors for the purpose of investing in a set portfolio. This is composed of several different asset classes. Let's take the example of an individual who wishes to invest his money in a balanced portfolio. This can be composed of bonds, stocks, and cash. Unfortunately, the individual might have a limited amount of money to invest, which would prevent him from many operations. However, by investing his money in a mutual fund, the investor would get around this issue. A mutual fund would indeed allow the investor to pool his money with other investors with similar interests. By purchasing units in the fund, a single investor can get the exposure he needs for some investments. The aim of the mutual fund is to let the individual investors allocate their money in ways they could have not otherwise. Furthermore, investing in a portfolio composed of different assets permits to reduce risks thanks to the spread out investments and diversification of the portfolio. Coming back to the example of cash equivalent assets, they are often operated by governments and financial institutions because the transactions imply very large amounts. With mutual funds, individuals have access to those.